Welcome back to Verticals, everyone. Today, we are excited to bring onto the show Nick Tippmann is the founder and managing partner of TipTop VC, an Austin-based first check fund focused on vertical software and AI. Nick, as an operator investor, has built up a great portfolio, including GC.ai, which just announced a great Series B raise in the legal tech space, as well as Sante. Today, we're going to dig deep into vertical AI strategy. We're going to touch on the recent SaaS flash crash and what that means for both horizontal and vertical AI companies. We're going to discuss where value accrues in this dynamic world of AI and what sorts of business can actually capture that value in a durable way. We are incredibly excited to bring on our friend Nick to the show today. So without further ado, let's get into it. Welcome back to the show, everyone. Today we have one of our favorites, another fellow VC and vertical AI enthusiast, of course, Nick Tippmann. Nick, welcome to Verticals.
Yeah, thanks for having me, Nick. I'm super excited to be here with you and Luke, longtime listener, and excited to join and have a great conversation here today.
Absolutely. The more Nicks, the better.
It's the battle of the VCs today. I like it.
The battle of the Nicks that love vertical AI.
Yeah.
We're getting super niche already.
Yeah, well, we love our niches here. Well, Nick, do you want to kick us off with maybe you can do a better job in your background than I did? And yeah, just tell us a little bit about what you're up to at TipTop.
Yeah, for sure. I mean, you did a great job, so I won't add too much, but I like to think of myself as a founder, operator at heart, turned investor recently. Grew up starting businesses, started a couple of companies after college before Greenlight Guru, raised some money with one, got into an accelerator with another, and bootstrapped a media company to a small exit after that. But then as you mentioned, most recent relevant was part of the founding team, CMO at Greenlight Guru. We were a B2B or are a B2B vertical SaaS for the medtech industry, help medtech companies get approved by the FDA and stay compliant once they got to market. Yeah, as you mentioned, we had a great ride there. As you can imagine, as technically the first employee, wore many, many hats over our 8.5-year ride there. So always led marketing, led RevOps as well throughout that time period. Once private equity came in, got to lead product interimly for a year, and was leading strategy and corporate development before I left as well. So had a broad range of experience at Greenlight that then translated over well to starting TipTop Ventures, which is early stage vertical software and vertical AI specific fund, leveraging my background where we write smaller collaborative checks of 100 to 400K alongside other leading investors like Euclid. And in addition to my background, I've also built an LP collective, primarily 95 other exited vertical software founders from places like Toast, Shopify, Procore, Mindbody, ServiceTitan, etc.
Awesome. I know we want to get kind of deep in the playbooks today, but I just wanted to kick off with this question. What drew you to, investing professionally, and did that start with angel investing or, particular insight? I know there are a lot of folks who are angels and maybe thinking about doing venture full time, and how did that pair with your expectations?
Yeah, for sure. I think I have a little bit of an unconventional path into venture, but I don't know that there is a conventional path when you talk to most folks in it. But I like to say my journey started back my senior year of college back in 2011, 2012. I was studying entrepreneurship back at the University of Indiana. As I mentioned, always very entrepreneurial growing up, always grew up wanting to start a business like my dad, like my grandpa. When I got to my senior year, I realized that the question I went to college asking is, how do you start a business? The better question is, that I was looking for is, how do you start a high growth, venture-backed, scalable tech startup? And being a kid from a small town in Indiana, a lot of those words were pretty foreign to me. But if you remember back the early 2010s, it was kind of the beginning of VC blogging. And so some folks that probably on this show will recognize the names, people like Brad Feld, Fred Wilson, Mark Suster, Paul Graham, got turned on to their blogs pretty early. And I had this realization. I was like, wow, well, if 3 out of these 4 founder entrepreneurs all went on to become venture capitalists, it probably seems like a pretty interesting gig here. So became fascinated with the whole venture side of things, getting into tech and then operating and starting companies after school there. And then over the last 14 years in my professional career, have been operating with the mindset of let's go be a successful founder operator. And then long term, I've always wanted to get into venture and raise a fund and build a firm. And I could get into a little bit more into the why now, and what got me so excited and excited about vertical AI as well. But that's a little bit of the backstory there.
Amazing. Well, congrats on everything so far. Well, Luke, I know you had some ideas on, kind of directions to take it on the playbook side. Where do you want to go?
Yeah, let's do it. So I want to go super deep today since we got the two VCs who see deals all the time, have a good basket of portcos and seeing what's working, what's not. So I want to go deep on a few things. I think the first one to start out is the SaaS markets are crashing, right? They're getting absolutely hammered. What caused this really is a few of the AI companies. I think it was specifically Claude, right? Claude launching some workflow tools, and people are basically panicking and saying, SaaS is dead. So I want to just kind of zoom in with this group for a second and talk about, okay, if that's happening, what's next? Is software dead? Specifically, is vertical software dead? And, how are you guys balancing this? How are you thinking about this? Where is the world going next year, 5 years from now, 10 years from now? So maybe Tippmann, you kick us off and let's make it a debate. I don't think we're all going to agree with each other here. So it should be fun.
It's certainly been an interesting time in the markets over the last couple of weeks, and all the talk about the SaaS apocalypse and is SaaS dead. And my take is I definitely believe the worries are certainly overblown. And if you think about what some of the root causes, you mentioned Claude releasing co-work. So are people worried that folks are going to build their own software and they're not going to need to buy software anymore? Is the seat-based model going away, and therefore the growth engine of these companies going away? Is Claude Code and Claude Cowork just going to be able to do all workflows and all processes and all work? So there's a couple of different kind of headwinds coming at SaaS right now. I think you got to pull those apart a little bit. But I think my general takeaway and sentiment as a whole is SaaS isn't dying, but it is evolving. And we're seeing, whereas the moats, we were pretty confident in our moats, in our system of records, our data gravity, our workflow gravity. And now in the age of AI, a lot of those moats are looking a little bit shakier. But I think this is really just setting up for a battle of epic proportions between AI native upstarts and the legacy SaaS incumbent providers. And as a whole, as a venture firm, we're definitely making our bet on the AI native upstarts being able to come in and disrupt these legacy providers. That being said, I don't think the AI native upstarts are going to make a clean sweep across the board. The incumbents have a lot of built-in advantages that if they're able to move fast enough and adapt, that they can leverage and lean on. Just starting with the fact they have the relationship, they have the trust. If they are the dominant system of record, they have the data, they have the workflows. Where the AI native upstarts have a lot of advantages is in their ability to move fast and their ability to build products that maybe some of the incumbents are thinking are cute or tools and dismissing them as point solutions, but not really understanding they have a broader vision. And if they're able to position them properly in the workflow, they may earn the right to own more and more of those workflows and the data gravity downstream over time. And so I think it's really the $1 trillion question of who's going to win, these AI native upstarts or the incumbent SaaS. But I think this flash SaaS crash is a little bit overblown, as you see some companies being all the way valued basically to their terminal velocity of cash flows and basically being zero, which I don't think the value for the majority of software companies is going to zero. But certainly there will be a lot of disruption, and this is the most uncertainty that we've seen in software markets over the last couple of decades, and really since the last platform shift from on-prem to SaaS and cloud. But Nick, I'd be interested in your perspective and how you're thinking about this.
Yeah, look, there's always a lot more baked into public market movements than a narrative as simple as, AI is now going to eat these companies. I think, we've still got some, persistent inflation going on. There's pressure there. I think that, something like only 70% of SaaS companies, hit guidance in terms of revenue growth. So like, I think there is some factoring in of both near term and then maybe due to AI long-term growth prospects. And, I don't know if you look at just median, public SaaS multiples, like they're not out of the band that they've traded in over the last couple of years. So I feel like you can't look into these swings too deeply sometimes. I mean, ServiceNow drew down 10 to 15%, but they've had near 100% retention over the last year, right? So sometimes it doesn't 100% make sense. But I think another one that was hit pretty hard was Monday.com. And, while that business, I mean, kudos to them, it's been a really cool story. I do think that it somewhat mirrors the archetype of the sort of business which people see as being increasingly exposed in the near term, right? I mean, if you think about outside of the surface level stuff of creating your own website, what are people doing with Claude Code? It's like, hey, create a dashboard for me, create a Kanban for me for my daily tasks or whatever, right? And now that's a far cry from we've got all the functionality of Monday.com, but like people I think are just starting to now make, the mental connection between what this could mean. And the biggest takeaway for me is that the most exposed are these generalist, horizontal, kind of universal solutions, right? It's kind of funny because we saw this rise of, vertical SaaS is exposed. And I always thought to myself, why vertical? Like it's the least
I never
exposed.
understood that either. That was Dave Friedberg on All In. And
I think honestly
about that for 2 years.
Yeah, same. And to be honest with you, I think Dave is a pretty smart guy. I think he kind of meant it in a different way, which was like niche-y, like, like something that's been around doing $1 million ARR for 20 years sort of thing that could be easily replicated. But, I do think, especially kind of generalist, like task tracking, stuff like that. I mean, even just playing around with, Claude Code or OpenClaw or whatever else is coming out, you can kind of start seeing how maybe you don't need reliance on that sort of UI anymore. But I think it wouldn't shock me if in another 6 months we trade back up to where we were in the public markets.
Yeah. So I have kind of strong views on this. So I think if you zoom out for a second and just think of a few different kind of pieces of software that we have today. So we have system of record. So your system of record could be vertical or it could be horizontal. System of record being CRM, EMR, in the healthcare markets, SIS in the education markets, right? So just core system where all the data lies. A step above that, you have a whole host of either point solutions or like very broad horizontal tooling that doesn't meet the definition of system of record. I think broad horizontal tooling would be like a DocuSign. It would be like a Monday. It would be a Trello, right? Things like that. And then above this now you have a new category, which is AI, right? So this is Claude, this is ChatGPT, OpenAI, etc. I think this is, and you can actually see this. We'll put it in the notes here. But OpenAI had a blog post on their new enterprise solution called Frontier. I don't know if you guys saw this. Basically, it kind of gives some takeaways into I think what they're thinking, which is the AI layer is going to eat everything except for the system of record. Like literally, the system of record is like the last remaining thing that they're not. At least in this blog post, it felt like they're not going after. And their whole view is like, hey, we're going to build agents that cover everything above that data set. I think that's important to note because the system of record is oxygen for AI. Like AI can't perform without the data set. I think if we steelman that for a moment though, the inverse, here you go. So it's your system of record here at the bottom. And then it literally has OpenAI taking everything above. And I think the agents piece is interesting where they have your agents. So the internal company could build them. They have OpenAI agents, and then they have third-party agents, kind of App Story-esque, right? But none of these things work without the data set. Back to the Steelman point, though, I do think I have read a couple of blogs where people are saying, hey, well, technically an agent could just kind of go into the system of record and pull all of that out. And then you don't necessarily need that. I have some views of this, but I want to at least pause there and get Tippmann's view of this, and then we can go a layer deeper.
Yeah, for sure. I think it's a really interesting diagram and aligns well with our thesis and views here at TipTop and where we think the value is going to accrue in the stack. Maybe 18, 24 months ago, I saw another graphic. I forget where I saw it at this point, but I thought it was a good way to describe kind of the different layers of the stack. And they had foundational models at the bottom, kind of small language models, infra tooling, and then apps on the top, both horizontal and vertical. And our core thesis at TipTop is that the value over time is going to accrue in that vertical application layer. And then what you see with this graph is basically saying OpenAI is going to do everything but the system of record. And so we understand that proprietary, unique data that these vertical solution, or really any system of record, for that matter, is going to continue to have value. What's going to matter less is the UI. What'll matter more is more the UX, the experience, the outcomes, more than interface stickiness per se. And yeah, so I think that's where we're going to see the value accrue. And then back to just real quick to double click on one of my points from my previous comment of the impending battle between the incumbents and the upstarts. To quote some data from Tidemark's, our friend over at Tidemark's excellent 2025 vertical SaaS survey. In 2024, they surveyed all the SaaS companies. I think there's like an N of 250 or so. And it was about 31% had released an AI product. And it was about just under 40% said they were going to release one in the next 12 months. Now, in the 2025 survey, the products, it was up to 55% of SaaS companies had launched an AI product. So a little less than half of those folks that said they were going to launch a product in the next 12 months actually did. And if you just extrapolate that out a year or two, that's by the end of this year, we'll be looking at 70% of SaaS companies, 85% by the end of next year. And so this is where the belief that this battle is taking place across every industry and every vertical. And yeah, it's the $1 trillion question on who's going to win and why.
I think we all can agree that my view is the most dangerous place to be is, and obviously this is the Verticals podcast, so people are going to knock me a little bit for saying this, but I do believe the most dangerous place to be is in point solution land, even if you're vertical, or in kind of broad horizontal app, like all these sales enablement tool, like all this stuff is not where I'd want to be. I've seen so many VCs retreat into the vertical, world, just because how likely is it that these big companies are going to really kind of move into, that space? It's interesting to think about. It's a tough piece. All right. I want to just quickly visualize to the bloodbath in the public markets, because I think it's helpful. And then I got two Nicks here. So Nick from Euclid, if you want to kind of opine a little bit on this. So this is Thomas Tungas from Theory Ventures. He's, great blogger, been a great blogger for a long time. He visualized where is everything getting hammered. So why are the three of us are disagreeing with the public markets in our previous statements? So like, what are they seeing that we're not? Like, what's the steel man on this, Nick? Why is vertical getting hit the hardest?
It's funny because I've actually seen other breakdowns of this that show vertical is getting hit less hard. So I think there's honestly some questions of
moving every second. Yeah, for sure.
Yeah, there's some question of how he's breaking it up here, but I think there's also honestly some correlation with company size rather than necessarily whether it's vertical or horizontal. On average, public vertical SaaS companies, and this is on average just because you have a lot of public vertical SaaS that's been around for a really long time, are smaller. And, generally mid caps and small caps get hit harder in downturns, right? So your big players, your big software players, which I don't know if he's including like Google, presumably he's including Microsoft, but certainly he's including Salesforce and ServiceNow are big, and they're just not going to draw down as much. So honestly, I think there's some correlation versus causation here. I honestly think if you look at some that have been hit least hard, and you can look at like Moody's or some of these other like FinServ players that, have like really strong vertical moats, they have actually been somewhat insulated from this downturn. So I don't know. I'm trying to think where does Viva fall on that chart, right? Where does Procar fall on that chart? And how much of that can we really attribute to their model versus just the size of the company? That's probably my take.
Tippmann, anything you'd add there?
Yeah. Look, I'll preface by saying I'm no public market expert by any means. And I also have seen some conflicting data as well, Nick. But I think one takeaway or one thought with that conflicting data is that we may have just seen that vertical market solutions have a little higher variance than our others, which would maybe give credence to your point on they're just smaller mid-cap companies and having higher variance as well. My gut take, but this really isn't a macro take, or would be trying to put a macro take on a micro or company specific, is that some of these vertical software solutions in the public markets are older at this point and are more legacy and are potentially more susceptible to an AI native upstart. And I think that even could have been a thesis 4 years ago, pre-AI, just with the next wave of cloud solutions and even the first wave of cloud solutions becoming more legacy, that it left room for a more modern, better user experience, but faster, more aggressive company to come in and have some vulnerability in the legacy vertical SaaS in general. So I'm not sure if that's flowing through at all, but that's one other theory I'd throw out there.
So we'll take our public markets hats off. And let's just talk about it from the customer lens for a second, because, that's obviously where the value has to be created. And then, that's the input, and the output is, the stock price and the charts and blah, blah, blah. But from the customer lens, like I've seen a lot of writing recently on, are people even going to use software tools anymore? Like, are agents going to be using the software tools? Like if you fast forward 10 years, and the easy answer is, hey, it's going to be vertical specific, but like, what's your guys' take on agent? Is there just an interface that we talk to and chat with, and then the agents go actually leverage like software tooling to take care of, business workflows? Like where are we headed?
Yeah, I think, I can start. I kind of have two thoughts here. One is that, I've always felt, and I think I probably said this on the pod before, you can't fly a 747 through a chat box. Like human nature is such that I get it. It's very intuitive. One text box, it works well for, kind of context like an open evidence, right? But the reality is it's not the most efficient way to engage with every form of work in the world. And, the same can be true of voice. We need visual ways to consume information. So I don't think UI is completely dead, nor do I think that, honestly, it makes sense that we're going to be in a world where all software is only this system of record decision data layer, and I'm going to use Claude or ChatGPT or Gemini to interface with all my software. It just doesn't make sense. I already have trouble keeping track of like my projects in, within those systems, right? So I'd say that's one caveat, but I do agree with the point other Nick, I think you made earlier, which is, and we've written about a little bit too, which is that, I think the UI and the interface layer, if we want to call that, is becoming more fungible. And, I kind of see two potential ways this could play out. One is that something I've called inception software. So like embedded in these solutions, right? You can have, their own version of a wrapper, a lovable, specifically to spin up UIs specific for every customer, for every user. There's no reason why the world has to look like Salesforce does, where you get incredible feature creep and every button in the world because it has to be everything to everyone, right? I should just have what matters to me in my role at my company. And I think that's obvious. But there's no reason why platforms shouldn't facilitate custom experiences today. The second, which I think is probably a little further out, I think of as bring your own UI. Today, that's already somewhat happening on the margins, people creating their own dashboards based, from whatever your ADIO API. But, if you just draw that forward, there may be a world in which you don't as much have to worry about it. I do think, though, it's not just the data. It is also what we've been calling this decision layer, what some people in Silicon Valley have been calling the context graph. It's not just the data. It's not just the intelligence that comes from the labs. It's the context around how to make decisions for your industry and your company. I think that is like the meat, that I've been most excited about.
That's interesting. Like the permissioning, like the industry specific permissioning being a key driver of what the AI is responding to, talking through.
Yeah, exactly. You're going to get from LLMs general intelligence, and I don't know, will they have certain areas where they go somewhat vertical? Maybe, but you need a layer that is ingesting first party data, is ingesting third party industry data, that understands if you're a GC, that understands what a takeoff is and what happens after that, right? Or if you're an owner of a medical clinic, right? What it means to be HIPAA compliant in your conversations, and what it means to treat a patient, I don't know, post procedure, right? So I think this context graph decision layer, it's just the meat of what vertical SaaS is today. Just it doesn't necessarily require the traditional UI. We wanted to take 10 seconds to call out our partner and supporter on verticals, Paraffin. You already know why embedded finance is important. You want to power all the ways your customers make money and grow their business. But you don't want to be a bank, you don't want to be a credit card company, you don't want to be a lender. Paraffin can help you with that. They help portfolio companies of ours, friends of ours, hundreds of other vertical founders increase retention, increase revenue, grow their TAM. So if you don't know Paraffin, please take a second to check them out. You can go to paraffin.com, that's 1F, or the link is below this video. Thanks for listening, and back to the show.
Yeah, I definitely agree. And that well said, Nick, there. I think the UI will matter less. Things like authority, permissions, audit logs, deterministic workflows, rails to make sure those workflows end up being deterministic will matter more. I also was thinking about this talk and thinking about the concept of UI versus UX, and where I think maybe the UI is mattering less, but the UI or the UX could matter more. Outcomes are mattering even more than how much time you're spending in the platform. It used to be measured on how much of a worker's day is in the platform. Now a better unit of measurement might be how many tasks did you take off that person or the individual's job's plate that day. And it doesn't matter if that agent's living in Slack through APIs, a headless platform, embedded in solutions like you mentioned. But I think the winners will be thinking about things like audit logs and logging everything first, having human in the loop by default, but getting the ability to own more and more of the outcome over time. But you need to build in that predictability and the trust, and I think that's going to be particularly important in the long tail of these industries that a lot of us are looking at.
So I got one more theoretical, and then let's move into the tactical for listeners and kind of what's working within your guys' portfolios and playbooks. So last theoretical is on outcomes versus subscription and seats. I think my fundamental view right now is everybody should be experimenting with this right now. Is I think the perfect model in my eyes for most vertical companies is some low level subscription based mechanism with an outcomes piece on top of that. Like I'd really like that model. I'm curious like how you guys view that. Obviously like the one side of the spectrum is like it's only going to be outcomes and like the only way to make money is outcomes and all SaaS is dead. And then, and then the other side is, hey, we're just sticking with our subscription fees. That's a very hard question for probably a lot of our listeners to answer if they're locked in at $10 a user a month and they're like, if I go to $5 and then price on outcomes, like, am I just going to cannibalize my revenue? So I'm curious kind of where you guys think where it's headed, where consensus may land. That's a tough one.
Yeah, I'm happy to jump in here first. I think it's a big debate and you're seeing a lot of experimentation going on between outcomes and seats. I think of it in many ways, though, as a continuation of pricing models that we've already seen. In some ways, a platform for seats model is great. The platform gives you some base model, and the seats is there to be a variable component. And then maybe in the late 2010s, early 2020s, we saw transaction or usage-based model, API keys, usage from places like Twilio, et cetera. And now you had this big debate on recurring versus reoccurring fees, which has kind of gone away in the age of AI. And it's just everything is recurring at this point. But when you peel back the curtain, maybe not so much. So to wrap that, I don't know how much is changing. So Luke, I agree with you that you should have probably the best that I've seen today is some sort of base platform model with some sort of variable component on top of it. And then when we get into the variable component on top of it, I think that's where the big debate and a lot of the testing and the hypotheses are going on right now around how much of the outcome that you can own and how much you can charge for that. And
sorry to interrupt you. I was going to say, by the way, I think founders too think that outcomes just simply means like a business outcome, like we lifted your revenue. I think a lot of people are getting lost that like outcomes could just be the AI generated a PowerPoint for you. It could be like very micro outcomes. It doesn't necessarily need to be like this monster it takes 12 months for us to see if there was an outcome. Like I think a lot of founders and CEOs panic over that because that's what they attribute to outcomes, but it could just be like very micro things like we generated a PDF or right? Just one piece of color I wanted to add.
Yeah, really well said. Just to double click and to wrap up the thought here, so that's exactly where I was going in the outcome and maybe some more practical or actionable takeaways of tips. If you're ultimately like an AI AE, and at the end of the day, you're selling a new closed won deal, like there are a ton of micro conversions that happen in there, all the way from booking the first meeting to when they didn't show up for the discovery call, that you had to reschedule that meeting, to have an AE, to have a demo. And there's maybe 10, 20, depending on how you break it down, 30 micro conversions in there. And so don't start with, I'm going to sell you a new deal and every deal for you is 20K ACV and I want 10% of that. So it'll be 2K per closed deal. Start with maybe what's the value of a new booked meeting for you, or what's the value of a missed call? If we could answer one missed call for you and get one more meeting booked, what is that value? So I totally agree with you that you should break down the outcome into smaller value units and kind of test from there. And then as you get confidence in your predictability and ability to deliver those outcomes, then you can take on more of those and capture more of the value that's associated with the outcome.
Yeah, well said.
Yeah, I think there's always a perennial battle between two things here. One is more like a basic human psychology thing, which, in which essentially the buyer, they want visibility and simplicity. They want to know what they're going to pay for something. They don't want to be surprised by, some vendor costing them 5 times what they assumed they were going to pay. And I think in experimenting with AI, we've probably all experienced that. It's like, oh, sweet, my Anthropic bill is $400 this month. Like, I guess I should turn that off, right? So, and on the same side, any startup, any investor in a startup would love to be able to, kind of like traditionally in SaaS, say like, okay, well, as long as our churn isn't crazy, and, we continue to do well in sales, we know what our renewals are going to be. And so we have visibility into how the business is going to perform. And so, I think there's that one psychological side that will always inherently push people back to having at least, as you both said, like baseline okay, you're going to pay this, and that's going to, maybe it'll get you tokens, credits, it'll get you to a certain level. And then if there are overages or we over deliver on what we promise, then we will take a cut of that. So I think I think I'm broadly in agreement that is probably where it will net out. I would just add one thing in though, like if you are offering, as a startup, as an AI startup, if you're offering a service that does not have a strong moat or is not otherwise like integrated into, a platform that the company is reliant on, then ultimately your pricing power will get competed down to the marginal cost of delivering that service, right? If you're an undifferentiated AI service, it totally makes sense that you go to a business owner and you say, hey, you have this service now. This guy creates a PowerPoint deck for you, and he charges you $10,000 a year to do this across your whole business. We're going to do that for $1,000 a year. Of course, he's going to say yes, right? But eventually, there's going to be 40 other players doing the exact same thing, and so they will compete away that margin, and it will come down to whatever the input cost is. So, like, I think it's just really important to think about, like, as you think about pricing, like, what is your pricing power? How are you going to build a margin over time? It's great to grow quickly early, but I think we're entering an era, and I'd love to, like, Nick, get your thoughts on this, where across a lot of verticals, we may have 5, 10, I don't know, credible startups doing 5 million ARR offering the same, more or less, service, answering your calls at night, doing customer intake, scheduling. What happens? Like, probably not, they're all going to be winners. So I think that defensibility question is important for pricing.
Yeah,
What do you think about that? What do you think about that, Nick? Like, as you look at, because we face the same thing, as you look at a category where it's like, wow, it's a great team. It makes total sense. Like, you're selling the thing. Growth looks good, but I've met 7 others doing the same thing. How do you think about that?
Yeah, I mean, I think it's one of the big questions that comes up in nearly every opportunity that we're both probably looking at, right? If we're going after a vertical market, you definitely want to understand who are the legacy competitors, the incumbents in the space, but also a great risk in nearly any vertical worth going after is who are the other 5 to 10 great credible teams with great backgrounds also going after this same problem. And I think part of this comes back and gives credence to the belief that, like, I don't believe this, but it certainly was spread around a lot over the last year or two, that speed is the only moat left. I think when you are competing in a specific vertical and there is somewhat of a land grab type of moment, then speed really is a determining factor, that if you can go grab that land, develop stickiness, have the audit logs, the compliance, the context of the organization, well, then maybe that gets you running enough ahead of some of the other players in the space that you can create a big enough a gap. And I think where it comes back, that I always believe brand has been important, but I think brand will be even more important over time, particularly with the enterprises where trust and credibility will be a big part of the solution. So I don't know that there's a perfect answer out there, but things like network effects, brands that have been around, ecosystem lock-in, partnerships, trust will all go a far way. And I also think that's why domain founder fit matters so much. And particularly with, Luke, you've asked about playbooks and what's working. Like, one of the playbooks that I've seen work well across our portfolio and across industries is just a community-led, content-driven, educational-based playbook. And if you're able to make your founder, CEO, or someone on the executive team the figurehead of that, and really lean into that and build the trust and have IMBS and get the industry believing in you and believing in your vision, so that they're not just buying what you have today, but they're buying your 12, 24, 36 roadmap as well. Yeah, there's some of the ways that I think about it. No clean answer again right now, but yeah, some of the different.
I think it's a really good thread. Just, I think one thing I would add, and let's just look at history, right? Because history repeats itself, is like, we had the same thing happen in the cloud era, right? There was probably 100 different toasts, right? And there was one winner that got whatever it is, 50, 60% market share. So if we're in a similar moment in time, and they were battling like hyper legacy, like on-prem stuff. And so that's not the case today. But I think what it really came down to was go to market was so important. And like, I think when you hear about like Toast early stuff, they were feet on the street. They were like geo focused. They were building relationships in like very targeted, like small geographies. I think around Boston is where they started. And you had a bunch of other people that were running like product led growth because that's what was the cool thing. And like, that's what everyone said to do because the economics looked better. And, and Toast won. So I think go to market is actually, everyone wants a product led growth motion, right? Because it's typically the cheapest, but I don't know, maybe like go to market outside sales becomes a stronger mode in this era. It's interesting to think about.
Yeah, I mean, I think distribution matters more than ever, and that's something that's unique in a lot of ways. Well, it's not unique just to vertical software or vertical AI, but I think distribution can provide uniquely powerful advantages in vertical markets, right? Because they can be harder to access. They have different partnerships, ecosystems, and it can be more difficult to unseat. So, yeah, I think you said it well, Luke. Like a lot of the breakouts we've seen so far, because we've got to remember, like, I don't know, we're all talking about Cloud Code. Cloud Code like wasn't a thing a year ago, right? Like these things are moving very quickly. The breakouts we've seen are, a lot of these PLG, like open evidence style things. And it kind of makes sense because like,
that's the fast. Yeah. That's the only thing that can grow this fast.
Exactly. That's the only thing that can possibly grow this fast. Now, that doesn't necessarily mean that in 10 years, that's going to be the best company versus ones that...
Evolution IQ. How many Evolution IQs are happening right now in the enterprise?
Exactly. Like for listeners out there, this is 2-3 episodes ago, we talked with Mike Saltzman, founder of Evolution IQ. They, a couple years to, nearly $1 billion exit, had zero revenue in their first, year, 18 months.
35K ARR in year 2.
Yeah. And that's because it was like, look, we're selling into insurance companies. We got to get this thing right. So they worked with one design partner for an entire year, making almost nothing. And that's very different from like, hey, let's create this new thing, get it in as many hands as possible. Look, I personally think you could extend that to a lot of these companies. They're like, hey, look, I did 0 to 3 in a year or whatever it is. Like, I mean, yeah, that's like absolutely, I will not argue that that's incredible, but like, are you going to keep growing? Are you going to retain that revenue? Also important questions.
So this is a good segue. So we've talked pretty theoretical. Let's get tactical. I want to try to zoom into some playbooks in what's working in this era that listeners can hopefully learn from and experiment with their own companies or with companies they're involved in. But maybe Tippmann, let's kick it over to you. Like, is there any kind of playbook? And what I mean by playbooks is like a few actionable steps that you saw create, really interesting growth, really strong growth. Obviously, Nick was very early in GCAI, so congratulations. That business is incredible. Like, I'd love to hear from both you guys. Like, what are some interesting kind of new AI age, steps and actions that you've seen really work in today's world?
Yeah, for sure. Happy to kick it off and get a little more tactical on the go-to-market front. I wish I had a great answer for you and that there was this silver bullet answer, but this is where maybe I'm the boring old operator that like this is just about disciplined execution and setting up the process the right way and running it properly. I think what's more important than ever, and I always thought it was extremely important, it was advice that I was given 5-10 years ago as a RevOps leader of just how important revenue operations and data are to your entire business operations. And now I'm also pulling in product and financial data into that. So what I see, the best companies, they instrument their companies and their go-to-market engines early and they think about their go-to-market engine and RevOps just like a product. They have a backlog, they have priorities, they have, like we did at Greenlight Guru, had weekly demand gen meetings where the owner of inbound, outbound, events, AE sourced, upsells, renewals, onboard, everybody came in and had to report their number on the week and give a red, yellow, green if it's on track. And if you're a yellow or a red, then what was the immediate action that you were taking? And you better go take that over the next 5 days. And when we are back here all next Tuesday, reporting on what action you took and what outcome you had on that result. Now, I think what the data, focusing on the data and the RevOps and the enablement early allows you to do is pretty cool. It allows you to be much more efficient and to get more SQLs per SDR or a higher quota per AE. It's making the whole ship and the machine more efficient. But I think the silver bullet is really not a silver bullet at all. It's just back to the practice and focus on the fundamentals and the discipline and instrument your company early so that you know what is working and what isn't working. So when something is working, you can press the gas and really push on it, whether that's community-led marketing, founder brand on LinkedIn, doing educational webinars, partnering with industry associations. All of those could work or none of them could be working. But if you're not measuring and building the data back into your brain, then you won't know, and you won't know where to press on the gas or where to cut.
So I like Nick's approach is like day at a time, right? Like I remember when we really started measuring channels and testing, and this changes, by the way. Like you could have a channel kicking ass and it stops kicking ass in 60 days or 90 days. And I always tell founders, I'm like, literally, when you're just starting out, make a spreadsheet of a couple channels, test them rigorously, and then whatever working, go deep as you can and hold on to it as long as you can, because it's at some point it's going to stop working. Just to push a little bit on you, like how are your company, like the fastest growers in your portfolio? Like are they product led? Are they sales led? Are they, it felt like you were kind of doing you're speaking to a combination of everything. Like where are you seeing, at least broadly, like success coming from? Is it in PLG because we're just at the beginning of this AI era?
I'm happy to take, yeah. I definitely have to, just the physics of sales, PLG does lend itself to the fastest grower. That said, I think then the proof is in the pudding, really, and what is your second act and your ability to run the layer cake strategy, continue to grow ACV and actually be able to retain that revenue. But not every company that's growing quickly in the portfolio is PLG. We have some that are more traditional system of records. Actually, one in the portfolio that you just had on your last podcast, Darren Finke, who just announced his round for Sante earlier today, had a really unique, interesting angle that he shared on your podcast around being able to rip and replace legacy tools and using AI to do that. I thought that was a really interesting.
He's hammering the phones.
Yeah, hammering the phone, just old school hammering the phones, and then having a unique way to rip and replace. And I've got one like more traditional events, like they're going to the random plumbing conference and the random HVAC conference and putting boots on the ground and shaking hands and getting out there with folks. I got a portco that's running a forward deployed model that's going much higher, 6-figure ACVs to start. And so they need to go in and deploy, but 80% of what they're building is replicable across customers. And so they're able to grow quickly with these larger ACVs. So yeah, not all PLG, but PLG definitely does lend itself to fast growth. But in that scenario, then really comes down to your second act.
Love it.
I've found that I think I would argue more broadly that like PLG is generally less common in vertical. I'm not saying it can't be. Obviously you've got open evidence. There are certainly some fast growing legal AI businesses, but in general, a lot of buyers, especially once you look below the enterprise, because I don't think this is true of Harvey, do not care that it's AI. They want solutions to their problems. And, in a lot of categories, some of these blue collar categories we're talking about, it could be a turnoff, right? And so I think what I've seen is more traditional selling cycles. And then once you start to become somewhat of like a known quantity in the space, then you can get more PLG, but like that start has to be more so selling something that matters to the buyer in your vertical. And that's probably not selling AI. It's probably selling, hey, I'm going to bring back revenue. I mean, we talked about some of these, but like scheduling can work very well because it can, recapture that lost 10, 20, 30% of your revenue that was due to cancellations or inefficient scheduling, right? Like voice AI intake can work very well because it can bring back revenue from lost leads because you just don't have enough people in the office or you've got to sleep, right? So those sort of like revenue connected, very discrete wedges we've seen work well. I don't know that that one's a surprise or a secret, but maybe like two other things I'd point out. One is pretty consistently the best growers in our portfolio sell way ahead of product early on. And I think it's just they come to understand really what the problem is, and they find that problem that is so hair on fire that people are willing to like make the bet even in advance of having the perfect product. And in some cases, even in advance of the product, they're like, I just want someone to solve this so bad or to get rid of this old solution so bad, I will pay you to do it right now. And so, I think that comes down to honestly customer discovery and kind of having that earned vertical insight or domain expertise. And then one final one, like maybe a really tactical one, since we've been maybe more theoretical, is kind of leveraging that understanding of the customer to give them something like almost like a takeaway that empowers them. So I think this was, who was it? I'm trying to remember who was either in our portfolio or in a collective, had this strategy in which they would basically do an analysis for the customer and present them, like in this case, it was an IT-oriented product and legal, and they would actually just give the legal team at the law firm like a complete breakdown of their current system, right? Kind of like just to demonstrate like, hey, we can already bring you value even though we're not customers. I think AI can be really well suited to do that. So I thought that was just like a cool tactical hack that I've been seeing.
Yeah, and back to Darren, just to brag on him a little bit, like he literally has on live demos them download a file and he shows his system populated with their historical data set on a live demo. I was like, that is so genius. So, I mean, there's a lot of creative approaches here. And I love it. So we're coming up on a time here. Let's kind of shift a little bit into rapid fire if we can. I'm curious, Tippmann. So this is like our little rapid fire segment. We'll throw 5 or 6 questions at you, but I'm curious kind of for your take, like so first question is, where are you seeing graduation metrics? And maybe it's, from seed to series A. Is it like 5 million? Is it 10 million? And then Nick, you can jump in with a few rapid fires on your side.
Oh man, this is a great question, highly debated topic, and probably has the never fun answer of it depends, particularly in the early stage, and particularly today when you do have the possibility of these 1 to 10s, 10 to 30, 1 to 100 in a year. And those options are out there, and VCs know they're out there. It makes for a tough middle ground for a lot of really great companies that are building solid, durable businesses, providing real value to their customers that just aren't finding the venture dollars that they once have. I saw the data analyst Peter Walker over at Carta, who always puts out tons of great data. I'm sure most of your listeners will be familiar with him and Carta's data. He actually just repurposed some data, I think it was from Silicon Valley Bank earlier this week, that showed the average ARR at pre-seed, seed, Series A, and Series B. And the dispersion from the bottom quartile to the top quartile was unbelievably high. I thought it was pretty crazy. But if I remember properly, I think the bar for seed is pretty low, which would say it's still a lot of bet on the team, bet on the market, bet on the size of the opportunity, around 220K. And then for for a Series A, whereas traditionally maybe a couple of years ago, you thought the bar was get to $1 million in ARR. That certainly has gone up. On this data set, which I believe was from the last year, 2.5 million in ARR was the median for a Series A to get done. But I think bottom quartile was something like as low as 750K and top quartile was like 5 or 6. So it was vastly different. And obviously that data didn't take into effect growth rate as well. But I would say A is somewhere between 1 and 3 in general these days, and seed somewhere 250K to $1 million, and pre-seed, pre-revenue to 250K.
Yeah, no, I mean, I think that squares. I mean, it's kind of funny because in this environment, like, because of the increased growth potential of these businesses, there's more pressure on seed or Series A funds to preempt. And so on one hand, you're hearing about how Series A bars are higher, which they are. At the same time, I think you're seeing sometimes companies get these big rounds, like basically like if you just think about, call it time to $10 million raised, like that's, I'd say, shortened in a way for high quality companies. So it's a unique market right now. Nick, what do you think, like, how do you think that the ideal founder profile, like the characteristics you look for in the best founding teams, has changed, if at all, in the, kind of post LLM era?
Yeah, I think it has changed and rotated a bit in my perspective, placing an emphasis on learning quickly and having seen greatness before over domain expertise. I think the domain expertise is still important and needed on the founding team, and you should have some unique insight as to why you're starting the company. But I don't always believe that domain expert needs to be the founder CEO. I think it's actually probably harder to learn how to build a high growth, venture backed, scalable AI startup that needs to go 1 to 10 million in 18 months to be attractive to the venture market than it is for a 20-year insurance brokerage agent that knows insurance workflows up and down to take that knowledge and go and spin and learn all the AI and high growth stuff. And then also with AI, it's just been the ultimate leveling of the playing field. And so where expertise traditionally has been higher valued, now that everybody more or less started as a beginner with AI 3 years ago or so, really started a lower playing field. And so that slope or that rate of learning for a founder and their ambition and having seen greatness before, I've been placing a greater emphasis on these days.
What do you think in terms of technical talent? Have your views changed there at all in terms of either founding? Like, do you need the CTO to be in the seat to invest? Do you need the founding engineer? Like, or does it vary based on the team?
Look, we definitely want to have a founding CTO on the team. That being said, I do think formal CS technical skills maybe slightly less important, in particularly the vertical AI and niche industries that we're focused on, where not a lot of the innovation is particularly on the software that they're building per se. And then with the rise of all the coding and AI tools, the knowing what to build and having the taste of what good is like is, I think, trumping the value of having a technical skill set. That being said, also just coming from a go-to-market and operator background, I tend to have resonate better with go-to-market leaders and go-to-market and business background than technical founders. So I think on a whole, it hasn't changed who we target or who we focus on. We have technical and non-technical founders. But I think on a whole, the importance of that is going down some, and the importance of being native and fluent in all of the AI tools is going up.
All right, I'll bring us home with the last rapid fire question here. What is your AI stack? What are you using, and what's the coolest thing that you've done with AI?
Right on. Look, at my VC stack is probably pretty standard for many VCs. I'm using Affinity on the CRM. I've heard great things about Adio and others as well. I'm using Granola from a note-taking standpoint. And then my most exciting workflow is then I'm using basically a system of action or engagement that sits on top of my CRM called Velvet FS that allows me to ingest meeting notes, deal notes, emails, and company materials and documentation into its own folder or container. And then I can query and have different agents on that of go run the TAM analysis, go do a competitor analysis, go look at news in this sector, go look at fundraising. And so then once all that data is in one spot and it's all pretty much automated, I can then just go run these automated bots and do 60, 70, 80% of the work that I think traditionally an analyst would have been doing. And that's how I've been able to scale a bit as a one-man solo GP fund.
Not a good time to be an analyst.
Yeah, well, conversation for another episode, but that's for sure. Yeah, no, it's a cool time. I mean, we built a couple things internally, but have you guys seen this whole thing with like Cloud Code? Sorry, not Cloud Code, Cloudbot, Moltbot, now called OpenClaw. I've been playing around with that, and it's pretty cool. I'm not gonna lie. I mean,
you're texting it, right? I haven't tried it yet, but you text it and then it takes action.
You can set it up. Yeah, I mean, like I have mine connected to Telegram. You can set it up to whatever channel you could put connected to your Slack or whatever you want. But basically, yeah, I mean, it just is more. It's easily connectable to really any communication channel. But then, on the back end, it has access to whatever you give it access to. And yeah, exactly.
Go buy a Mac Mini, or you hook it up to your real rig?
I didn't really see the need for that when you can run it on a 10-year-old laptop just fine, but
can it send like love poems and words of affection to my fiance? Because I always forget.
It definitely could. It definitely could.
Would she think it was me?
If you gave it access to all of your past poems, I bet you could get pretty close.
I've got a huge database of prior poetry. So.
Just make sure she doesn't watch this episode. You'll be good.
Yeah. She'd be sleeping if she watched it. I know that for sure. All right. Well, Nick Tippmann, you're the man. Thanks for being here. Thanks for jamming with us on Verticals. It was a fun episode. So we appreciate it, and kudos on everything you've done and are doing, and excited for where you go next in Verticals.
Yeah, man.
Thank you, Luke. Really, really appreciate you having me on. Had a ton of fun talking with you and Nick here today. Hopefully there was some good nuggets and insights for your audience here as well. But yeah, I've really enjoyed it, and thanks for having me on.
Awesome.
Well, that's a wrap for today's show. Thanks everyone for joining. We'll have another one coming at you next Wednesday. So hopefully it was a helpful episode for you. Luke and I really enjoyed it, and we'll see you again soon.